Know Your Customer, or KYC as it is mostly known as, is something we experience almost on a daily basis without really noticing. A new credit card, loan, or bank accounts being opened all require a level of KYC to be performed. In today's video, we will be taking a look at what is Know Your Customer, when does KYC apply, and how to get into the KYC industry. Hello and welcome to another KYC Lookup video where we bring you AML related content to help you enhance your knowledge in the fight against money laundering. Before diving into today's video, be sure to subscribe so you don't miss out on any future videos. Oh, and don't forget to leave us a comment with any suggested topics you would like us to cover in the future. We also have a special announcement to make, so be sure to watch until the end to find out what it is. So, on to today's video. What is Know Your Customer? Know Your Customer, or KYC as it is better known, is the process of being able to identify who your customer is before entering into a new relationship. Like all relationships in life, if the risk is too high, we wouldn't want to start the relationship. Or if it sounds too good to be true, we may want to find out more. The KYC process consists of being able to tell the difference between approving or disapproving a relationship. For example, disapproving means anyone with political or criminal connections, or with a history that otherwise deems them to be too high risk for you to consider agreeing to have a relationship. Sourcing high-quality KYC information has historically been a tedious, difficult, and unreliable task. Even so, financial institutions around the world have been required to do this for over the last few decades. After all, lending money to or servicing a person who presents a high risk of default or who may be involved in illegal activities can be incredibly damaging for any bank or financial institution. Many other industries are only now facing the reality of international business and introducing measures to ensure widespread KYC compliance. Unfortunately, this is an entirely new activity for many organisations, leaving them unsure on how to acquire, correlate, and analyse the right information. It will be your organisation's responsibility to prove its KYC compliance and that everyone involved has done their part. This involves documenting and keeping relevant records on all clients, including their business type, the nature and size of their transactions, as well as the source of their funds and the reason of the existing business relationship. Failure to do so brings with it significant risk in terms of financial cost, reputational damage, and potential judiciary consequences. At a minimum, organisations are generally required to document clients' business type, their source of funds and wealth, the purpose of specific transactions, and the expected nature and level of transactions. There are 4 primary objectives when gathering KYC information, using a risk-based approach. Identify the customer. Verify the client's true identity. Understand the customer's activities and source of funding. Monitor the customer's activities. While there are a number of high-quality free resources of information, such as search engines or public databases, finding exactly what you need from this vast range of resources is incredibly time-consuming. This simply isn't a feasible long-term approach for any business that values speed, efficiency, and scalability. It's also absolutely essential that all sources are verifiable and trustworthy. What industry sectors need to comply with the KYC process? If you operate in a regulated market, including financial services and related sectors such as insurance, legal services, real estate, accountants, and law firms, you are required to perform Know Your Customer checks, KYC, as part of your anti-money laundering AML obligations. This is to ensure that the customers or clients you are onboarding do not use your services to launder money and unwittingly make you complicit to the act. Why are some companies reluctant to implement KYC AML compliance? As crazy as it may seem, some companies are still showing reluctance in implementing a KYC procedure into their business. But why, you may be thinking? When onboarding a new customer or client, the information gathered needs to be entered into the system manually. Hiring and maintaining a whole new KYC compliance staff can be costly for any business, and so can result in just basic information being gathered, increasing the risk of money laundering. Criminals seek out industries who have little or weak KYC procedures, and that's why they are drawn to the cyber world, where there is little regulation. If you want to find out more about crimes being committed online, then take a look at our video on money laundering in the gaming industry. Even the healthcare sector doesn't escape the criminals' dirty clutches. Since 2019, according to Onfido, which is a technology company that helps businesses verify people's identities, the healthcare sector has been hit with identity fraud, which has had a 44% increase. Criminals will steal someone's identity and insurance information and use that to have procedures done on themselves or obtaining prescription drugs. This not only affects the victim, but also the insurance companies, who will then find it very difficult to tell the difference between the criminal and the actual victim. But there are solutions out there which can help industries create an easy and streamlined KYC process. Shufti Pro is one of them. Onfido is another. Both use facial recognition technology to verify a customer or client and can have information ready to use in the matter of minutes. How to get into the KYC industry? In general, when applying for a KYC analyst role, it is preferred that you have a degree in either law, economics, or business management. However, this is not always a must-have. If you have the ability to, be a self-starter and master of time management, consistently sustaining high levels of productivity and quality in a fast-paced, high-volume environment. Clearly document and support judgments, decisions, and rationale, which will necessitate strong writing skills and the ability to maintain files and records in accordance with department standards. Demonstrate sound judgment and decision-making in the context of regulatory requirements, company policies, and industry best practices. Apply project management and organisational skills to a variety of tasks, demonstrating flexibility and problem-solving skills. Good communication skills, strong written communication, and critical thinking skills. A self-motivated team player, a tactful negotiator with strong people and process management skills. Strong organisation and prioritising skills with the ability to quickly react to ever-changing business needs. Ability to learn and use a variety of systems and technology. Consistently curious, seeks and implements new solutions and novel workflows. Operates in a high-stress regulatory environment with consistently changing expectations and close regulatory and audit scrutiny. As you can see, for an AML KYC role, although it helps to have a degree or professional qualification, it is not always the main driver at the time of being hired, even for a junior role. Well, there you have it. What is Know Your Customer? When does KYC apply? And how to get into the KYC industry. Please let us know in the comments section if the KYC process helps in preventing money laundering, or if you think we can all do more to tackle this rising problem. Now for the special announcement mentioned at the start of the video. We have now launched our very own courses for you to take a more in-depth look at a variety of subjects, such as Introduction to AML, Beneficial Ownership, and Customer Risk Rating, for example. So make sure you visit our website for further details and let us help you connect the dots in KYC. Thank you for watching the video, and if you made it this far, don't forget to like and subscribe to watch more amazing videos.